Welcome to Wealth Talk, where we discuss all things finance and wealth building. Today, we're diving into a powerful tax strategy that can significantly boost your investment returns, taking advantage of the 0% tax rate for qualified dividends. Whether you're a student just starting your career, or a parent or grandparent looking to invest for your kids and grandkids, this video is for you. First, let's understand what qualified dividends are. Qualified dividends are payments made by corporations to their shareholders that meet specific criteria set by the IRS. These dividends are taxed at lower rates than regular income. For many taxpayers, that can mean a 0% tax rate. So how does this work? For the 2023 tax year, if you're a single filer with taxable income up to $44,625, or a married couple filing jointly with an income up to $89,250, your qualified dividends are taxed at 0%. This is a massive opportunity, especially for young investors just starting out. Now, let's talk about why students and early career professionals should consider investing as soon as possible. Investing early allows you to take full advantage of compound growth. Even small amounts can grow significantly over time. For example, let's say our young investor starts with a monthly contribution of $500 into a low-cost S&P 500 ETF, like VOO. This ETF aims to track the performance of the S&P 500 index, which has historically returned about 11% per year. Sounds simple, right? If our investor commits to this for 20 years, they'll end up contributing a total of $120,000. That's $500 every month for 240 months. But the real magic happens with compound interest. At an average annual return of 11%, here's how the numbers stack up. After 20 years, the investment will grow to an impressive $441,254. This includes our total contributions of $120,000 and an astonishing investment return of $320,754. Let's break it down further. Total contributions, $120,000. Total investment returns, $320,754. Total value after 20 years, $441,254. This illustrates the power of compounding and the importance of starting young. Now, what about parents and grandparents? You can also take advantage of this tax strategy through the annual gift tax exemption. In 2024, you can gift up to $18,000 per person per year without triggering gift taxes. That means parents and grandparents can contribute to a child's investment account without any tax implications. Let's say you have a grandchild and you contribute $18,000 to their investment account. If invested wisely, that money can generate qualified dividends over the years. If your grandchild's income stays low, they can enjoy those dividends tax-free. Let's discuss a powerful strategy that parents and grandparents can use to build wealth for their children and grandchildren. By investing $18,000 a year in a low-cost S&P 500 ETF like VOO, you can set them up for financial success. Let's dive into the numbers. Over 20 years, that annual contribution totals $360,000. But the real magic happens with compound interest. With an annual return of 11%, that initial investment of $360,000 grows to an astonishing $1,427,894. Here's the breakdown. Total contributions, $360,000. Total growth return on investment, $1,049,894. Total value after 20 years, $1,427,894. That's over $1 million in growth simply by starting early and investing wisely. Now here's an incredible aspect of this investment strategy. You can take advantage of the 0% tax rate on qualified dividends. This means that throughout the entire 20 years, the dividends generated from this investment can be reinvested without incurring tax penalties. This is a huge advantage. By avoiding taxes on qualified dividends, your investment can grow even more efficiently, maximizing the wealth you're building for your loved ones. So why is this significant? It highlights how parents and grandparents can play a crucial role in their children's financial futures by investing wisely and taking advantage of tax strategies. It's not just about saving, it's about growing wealth. Here are a few tips for parents and grandparents considering this investment strategy. Utilize the annual gift exemption. Invest up to $18,000 per child each year without tax implications. Choose low-cost investment options. Look for ETFs like VOO with low expense ratios to maximize returns. Reinvest dividends. Take advantage of the 0% tax rate on qualified dividends to further grow your investment. Start early. The earlier you start investing for your children, the more you can leverage the power of compounding. Here's how you can get started. Step 1. Open a custodial account. Parents can open a custodial investment account for their children. This account allows you to manage investments until they reach adulthood. Step 2. Choose low-cost investment options. ETFs like VO have low expense ratios, making them ideal for long-term growth. Step 3. Invest early and regularly. Contribute regularly to the account, taking advantage of the annual gift exemption. Step 4. Monitor income levels. Keep an eye on your child's income levels to ensure they remain within the 0% tax bracket. In conclusion, taking advantage of the 0% tax rate on qualified dividends can be a game changer for your financial future. Whether you're a student starting your investment journey or a parent or grandparent looking to set up your kids for success, now is the time to act. If you found this information valuable, give us a thumbs up and subscribe to Wealth Talk for more financial insights. Have questions about investing or taxes? Drop them in the comments below. We'd love to hear from you. Understand that knowledge is power. Watch this channel, gain knowledge, and become wealthy and powerful.